Okay, welcome back. Welcome to Chapter 8, or this is Receivables. Okay, so what are receivables? Receivables is a claim against people or a company and other organizations in order to receive payment from the sale of a good or service. For example, if I sell a product to a customer and the customer says, hey, I'll pay you later, I create what's called a receivable. It's a claim against that customer. The customer then pays me the cash for that product that they received some time ago. I then reduce the receivable or reduce the claim against that customer. So a receivable is generated basically from the sale of a good or service, but you have not yet received payment for. It's a claim against that customer. Another example could be a note receivable. Let's say I lend someone money, okay? I lend someone money. They will pay me back over time, or they'll pay me back at a later date, whatever the terms are, right? I lend them money, say, here's the note. That person then pays me back over time. It's a note receivable. Fritz, a question?
Yes, I'm glad that you already noticed. So I was told by one of my mentors, and she stated that when it comes to loaning out money, to have it presented in the form of a promissory note
Yes.
and have it get notarized.
Yes, absolutely. I totally agree with that premise. Anytime you lend somebody money, there's always that risk that that person is going to disappear. All of a sudden, you can't call them. Their number's disconnected. They moved. Whatever, right? Life happens. But sometimes there's a risk that that person, all of a sudden, they vanish after they get the money from you. So what do? You want to create a legal binding document called a promissory note. That promissory note outlines exactly when you should be paid back, by how much, what are the terms of the repayment, is it monthly, is it every other month, is it annual, whatever. You need to make sure that all of these things are clearly defined in the promissory note. Both parties should sign that promissory note, both you and the person you're lending money to. That promissory note should also be notarized by a notary public. That's a person that has a fancy stamp. They document that they've witnessed this promissory note. Okay, now it's legally binding. And so the same concept applies with a notes receivable. When you lend a customer money or you lend another business money, it creates a notes receivable. But with that notes receivable, you should be issuing that customer or that company a line of credit that is very clear with what should be paid back to you and when. And if there's interest involved or whatever, right? But all that should be clearly defined. So Fritz, absolutely, yes, I agree with your mentor on that. Notes and accounts receivable are a result from the sale of a transaction, also known as a trade receivable. The most common transaction creating a receivable is selling merchandise or service to a customer on account, also known as on credit, but it's most commonly called on account. And again, anytime that you see those words on account, it means it's either accounts receivable or accounts payable. On account. It's accounts receivable when you sold merchandise to a customer, they haven't paid you yet, it's on account. You sold it on account. Okay? When it's accounts payable, it's you received the bill but have not yet paid them, it's accounts payable. It's on account. The receivable is recorded as a debit to accounts receivable. So, and then it'd be a credit. The credit would be to sales, right? Such accounts receivable are normally collected within a short period of time, such as 30 or 60 or 90 days. Whatever is outlined in the agreement between you and the customer. I personally prefer 30 days or less, right? Because the reason being is because in business, you want to make sure that you have cash constantly flowing into the business. And you want to try to get that as short amount of period as possible. Some larger businesses, they may take longer to pay you, right? So let's say you own a business and you sell beauty products, okay? In your beauty product business, you are selling to a large customer like Walmart. Walmart is a huge customer, huge business. They have to send all, like the store has to send all of their invoices to Bentonville, Arkansas, where the headquarters is. And out of their headquarters, they then process it in their system, and then they will send you a check eventually. It usually takes 60 days because it's a huge company that you're dealing with. Okay, smaller businesses. Let's say you're selling your beauty products to a local beauty salon, right? That salon, you tell them, hey, 30 days, pay me back in 30 days or less. So that accounts receivable is going to be a little bit shorter, but sometimes it takes longer, right? But the average time is about 30 days. And they're classified on the balance sheet as a current asset. As you know, accounts receivable is a current asset. Reason being is because it's expected to be turned into cash in a short amount of time. Notes receivable, these are more long-term, formal written instruments where credit has been issued to a customer or to another business. Notes receivable. And again, it's formal. There is a promissory note. There is a clear definition of when you'll be repaid. If it's a notes receivable, it's usually within 1 year or less, typically. And it's listed as a current asset. If it takes longer than 1 year, it's a long-term asset. Okay. And sometimes it'll even be classified as current notes receivable or long-term notes receivable, depending on how long it's expected to take to be repaid. So if you're going to be repaid within 1 year, it's current notes receivable. Longer than 1 year, long-term notes receivable. The average amount of time is usually it's usually more than 60 days. More than 60 days. That's why it's a notes receivable. Notes receivable may be used to settle a previous balance that a customer has, but they haven't been able to pay you back for whatever reason on time. So they might contact you and say, hey, I want to take out a loan from you to repay you. And so you convert their accounts receivable to a notes receivable. It gets a little complex, but that happens from time to time. Other types of receivables include interest receivable. That's like if you issued a notes receivable, oftentimes there's interest included, and you'll receive interest in addition to the principal, and so that's interest receivable. Taxes,
Like a car note, right?
like a car note, exactly, except it's the opposite. So let's pretend that you're the bank, okay? You are the bank. Since you're the bank and you're receiving the car payment from your client pays you the whole payment. In that whole payment, you have principal and you have interest. The interest that you expected to receive is called an interest receivable. The other part is notes receivable. And you would have to break it up. So for that payment, like it's like 96% of that payment goes to the principal balance, and that other 4% goes to the interest, right? Then you have taxes receivable. This is like you overpaid in your taxes, and you're going to get a tax refund. That amount would be considered a tax receivable. Notes receivable from officers or employees. These would be like you lent money to your employee, or you lent money to a vice president or an officer of the company, and they're going to pay you back. That's called a receivable from an employee or an officer. I try never to do that ever. It gets very, very dirty when you lend money to your employees or to your officers. Fritz, you got a good story behind it?
No, I just need to hear an example in which that will be very necessary to do in your business.
Yep. So for example, you have an employee that comes to you and says, "Hey, listen, um, I need an advance on my paycheck because I'm short on cash and I might be evicted next month." And you, the employer, might be like, "Okay, I'll make an advance on your paycheck." Okay. What it does is it creates a receivable. You're basically lending money to your employee. You're putting an advance on their paycheck. You're saying, "Hey, employee, you're scheduled to work 80 hours over the next 2 weeks. I'll advance you your next paycheck through a receivable, and then that employee will then work that 80 hours, and that receivable will then be reduced by that amount of money that you would have normally paid them." So an example would be you're advancing money for your employee to, for them to be able to make rent or whatever it is that they're short on. Fritz, does that help to clarify it?
Yes, I also realize cash advance businesses is there because most companies won't do that anymore, right? So that's how people can create predatory businesses.
Yeah, yeah,
I okay.
you're right. And you'll notice that places like liquor stores, lottery sales, cash advance places, those are usually in impoverished neighborhoods, like areas within Ward 8 or throughout the city that where there are lower income people living. Those businesses are in those neighborhoods for reasons, right? They're terrible for you, the person living in that neighborhood. The reason why they're bad for you is because those are bad businesses. You should never be taking out a cash advance. It's like 1,000% interest. It will keep you in debt forever. Okay? Stay away from that. Stay away from the lotto. Stay away from liquor. These are bad things for people, for good people, right? They destroy neighborhoods. That's why you only see those type of places in lower income neighborhoods, because they are designed to quote unquote help the neighborhood when in fact it's a form of predatory advance on the neighborhood, and it actually does bad things for that neighborhood. So that's just my soapbox. I'm sorry I got on it, but it's something I'm very passionate about, I guess. Okay, so please never do a cash advance. They're terrible. Please just don't do it. Other receivables are normally reported separately on a balance sheet. Would be things like the sale of an investment that was not a part of the business in the first place. So let's talk about uncollectible receivables. Ugh, this part pains me. Okay, so in business, we have to account for the potential that your customer will never pay you. Okay? You made the sale on account, but the customer ain't going to pay you. All of a sudden, that customer vanished, right? They received their good or their service, but all of a sudden their phone's disconnected, their address is no longer there, whatever. They fell off the face of the planet. You're not going to collect that money, okay? We call these uncollectible receivables. It's a problem in business, but it happens. And it's kind of an expected problem. there's always going to be a percentage of your customers that will never be able to pay you, okay, for whatever reason. They go into 30, from 30 days to 60 to 90, 120, 180. Anytime they get over 90 days, that's when you should be concerned. Like, they're never going to pay you, okay? So in that instance, we have to write off that receivable. And how do we do that? So let's talk about it. Companies shift the risk of uncollectible receivables to the companies by not accepting sales on account or only accepting cash or credit cards. Some businesses, they'll say, hey, listen, I'm not even going to deal with accounts receivable. I only want to deal with cash, right? That's fine. You can do that. Or cash on demand or cash on delivery. Other companies that might be like, hey, listen, we know we're not going to receive the cash, so we're going to do what's called factoring it. And it's where I might sell my receivables to another company in order to get cash into the business. Or in some cases, I might just say, hey, listen, I'm going to write it off because I know I'm not going to get that money. We write that off to an account we call bad debt expense. So operating expenses recorded from uncollectible receivables is called a bad debt expense. This is also known as an uncollectible accounts expense, or most commonly it's called a doubtful accounts expense. So what does this mean? I take it out of my accounts receivable by crediting accounts receivable and debiting bad debt expense. I'm removing it from accounts receivable and I'm expensing it out as an expense for the business. I'm not going to be able to receive the cash from that customer, so I need to expense that out. I do that by debiting bad debt expense and crediting accounts receivable.
So this is where companies will sell off your debt to third-party agencies, and then the ones that don't sell your debt, they close out the expense, and then it goes on your credit, and those are the ones they tell you wait 7 years for it to age off.
You got it. Yep, you got it. But I guess one of the benefits to the company is that when the company utilizes a bad debt expense where they're expensing out what they would have otherwise earned from a customer in terms of revenue, is that your larger expenses means that you'll have less. I mean, it's not really good, but it's kind of good when it comes to taxes. You'll have less net profit. When you have less net profit, that means you'll pay less in terms of taxes, right? You're basically expensing that out. So yeah, I guess it's good and bad. Right? It's the necessary evil of business, right? Okay. Reasons for uncollectible receivables go into past due. It's so oftentimes your receivables, it's 30 days. You'll tell your customer, hey, you got 30 days to pay me. That 30 days goes by, they still didn't pay you. Then it goes into what we call net 60. They don't pay you in 60 days. It goes into what we call net 90. They don't pay you 90 days. Then it goes into a net 120. They don't pay you 120 days. You see the problem, right? They're not going to pay you. We call that aging. Aging. We're aging accounts receivable. It's called an aging report. Okay, and you'll learn more about this in Accounting 202. But an aging accounts receivable basically means that the customer didn't pay you in that first 30 days. It then goes into 31 through 60. Then it goes into 61 through 90. Then it goes into 91 through 120. Then it goes into 121 to 180. And then 181 plus. It shows the progression of how old that accounts receivable is getting. That's why we call it aging. We're aging that accounts receivable over time. And yeah, I've seen some really bad ones. So it gets interesting, especially when you're doing consulting for some of these businesses and you're like, oh my goodness, I see that you haven't been able to receive it. That's how the company makes a determination whether they'll sell their accounts receivable to these other companies just to get something, right? Customers don't respond when the company attempts to collect. The customer files for bankruptcy. The customer closes their business. The company cannot locate the customer. These are all reasons why something becomes uncollectible. Okay, so to write it off, there's two methods. One's called the direct write-off method. The other one is called the allowance method. The direct write-off method is where we record the bad debt expense only when the account is determined to be worthless, right? So why is it worthless? So like if it's like a $20 type of accounts receivable or very low value, and it will cost me more money to approach another company to collect it than it would for me to actually just write it off. I'll just write it off through the direct write-off method. It's usually used by small businesses that have very low receivables. The allowance method, it records the bad debt expense by estimating on uncollectible accounts at the end of the accounting period. This utilizes the generally accepted accounting principles where a large amount of receivables to the allowance method. What does this mean? Let's say I'm a large company and every year I expect that 3% or 5% of my customers are never going to pay me. So I will take all of my accounts receivable on average for that year and create what we call an allowance for bad debt, which is generally a percentage of my accounts receivable. And I'll put that in my allowance for bad debt account. And then eventually, I will either write off that amount or I will try to sell that to an agency to collect, known as a collection agency. Well, I'm sure at some point we've all had to deal with those guys, and I hate them. I had to deal with them before in my past. They're not very fun. Anyway, how do we do a write-off method? So in this story, we assume $4,200 from this customer has been determined to be uncollectible. So the entry looks like this. We debit our bad debt expense, $4,200, and we credit accounts receivable for that customer, $4,200. This shows off the write-off amount. We're taking it out of accounts receivable and putting it into our expense, bad debt expense. Okay, what about what if they pay you later? Okay, this happens too once in a while. Let's assume that we wrote off the customer, and then later the customer woke up and says, "Oh, I'm sorry, I did owe you that money. My bad." So when that happens, you know, because earlier we said, "Oh, okay, this customer is not going to pay us," so debit, bad debt expense, credit, accounts receivable. Then later in the year, the customer woke up, or we were able to find them or whatever. They said, "Oh, I'm so sorry, I'll pay you." So now we have to reverse that earlier entry, and then we have to input the cash. To reverse the earlier entry, we debit accounts receivable, okay, to return that fund to accounts receivable, and we credit bad debt expense to reduce that bad debt expense. So basically all I'm doing is I'm reversing that earlier entry, but then I need to enter a second entry to show that that customer is paying us. So debit cash to increase your cash and credit your accounts receivable to reduce your accounts receivable. Once in a while that happens. You know, you keep sending these notices to the customer. Eventually they wake up and like, "Oh, I'm sorry, I didn't know I was behind." You know, life happens. Here's another example. At the end of the accounting period, the customer had a balance of $200,000. we estimate that the customer will not be able to pay us about $30,000 worth. So what we do is we debit bad debt expense $30,000, and we credit our allowance for doubtful accounts $30,000. What this entry is showing us is that we are saying the customer owes us $200,000. We think that by the end of the year they're not going to be able to pay us about $30,000. This is called factoring. We're saying that they're not going to pay us the full amount. Okay, so we factor, or we allow that they're not going to pay us $30,000. Usually it's determined by a percentage of their total balance. And this happens for larger accounts.
So, Professor, on that last slide, is that a perfect example as if you originally took out a loan for a certain amount of money, but something happened, whatever situation happened, and you can't, so they go back to see a small percentage that you can pay, and then and that agreement would then close out, and basically wash your hand clean between both.
Yeah,
Oh, okay.
yeah, absolutely, Fritz. That's a really good example. But yes, that's one of the reasons why something like this would happen. Another reason it might happen is because let's say the customer was making payments on their account, and then all of a sudden that customer went bankrupt, or that customer, something happened to them, right? So then we would allow for a certain percentage and then basically wash that account out. Yep, that's exactly right. Okay, so let's talk about write-offs to that account. Customer account is identified as uncollectible. That will then write off that account, just like you were talking about, Fritza. So on January 21st, this customer's account of $6,000, we would write it off by debiting our allowance for doubtful accounts and crediting the accounts receivable to increase the expense and decrease the accounts receivable. So basically that's a form of writing it off, right? Let's see. Here's a nice visual representation. The adjusting entry goes into the allowance for doubtful accounts. Then we write it off by emptying our allowance for doubtful accounts account by expensing it. Here's how it looks on a T account. Another T account example. Here's another good example. And this shows you the two entries that are made, right? So we assume that this customer account of $5,000, we wrote it off on April 2nd, but later all of a sudden we were able to collect some of it. So we basically make the reversing entry for that amount. And then, of course, the increase in cash and decrease for that amount from that account, that customer's accounts receivable. How do we estimate uncollectible accounts? Again, it's usually based off of a percentage in most cases. Sometimes we base it off of past experience with that customer, or we use an industry average to get our percentage, or we simply forecast into the future. But it's typically a percentage that based off of our total sales. Since accounts receivable are created by credit sales, uncollectible accounts receivable are estimated based off of a percentage of credit sales. Now again, credit sales, that means that the customer is paying us on account. It's accounts receivable. That's what credit sales are, accounts receivable. So here's an example. Let's assume that this company, at the end of the year, before any adjustments, their balance of accounts receivable is $240,000. We expect that they will not be able to pay us about 3/4%, so that's $3,250 from total credit sales of $3 million. So how do we figure out what the bad debt expense will be? We take the total credit sales of $3 million times the 3/4%. to get us to 22,500 is the amount that we would debit to our bad debt expense and credit to our allowance for doubtful accounts. And here's how that entry looks. Debit, bad debt expense, credit, allowance for doubtful accounts. So again, you take your total credit sales, or this is also known as your total accounts receivable for that customer. You multiply it by the percentage that we estimate that will not be collectible. In this case, it's 3/4 of 1%. And that equals 22,500. Fritz, go ahead.
Okay, so what can you please give an example as to uh, a scenario that this would happen? So this is what they use for when you're filing from bankruptcy. Like, I need to understand better.
Sure. So what? Think of it through like a large corporation or a very large sale that you made to one customer. Okay. Let's say you had a customer that bought $3 million worth of inventory from you. Okay. And but it's not just the 3 million wasn't done in one sale. It was done over multiple sales. Okay. To that one customer. And based off of that customer's track record or based off of the industry average, that customer is likely not to pay you the entire 3 million back over that year worth of time or whatever, right? And so we are estimating that that customer will not pay back the entire 3 million. They'll pay back most of it, but they will not pay back 3/4 of 1% of that total amount. And this is common where a big business loses an invoice, okay, from one of the many purchases that they made from you. They lost an invoice and they lost the paperwork, and so therefore they never put it into their system. You then sent them multiple requests for payment. You never got that payment, and so therefore we would adjust that amount off, right? So that's one example. Another example would be the customer has been paying you back the total 3 million, but then all of a sudden they went out of business toward the end of the year. We would make the adjustment for that remaining balance. Does that help it, Fritza?
Yes.
Awesome. Cool. Good question. Here's how it looks from a T account perspective. Okay. Let's talk about analyzing the receivables. The analysis of receivables method is based on the assumption that the longer an account receivable is outstanding, the less it is to be collected. This goes back to my earlier point. This is what we talk about aging accounts. Let's say a customer makes a purchase from me and I expect them to pay me within 30 days. The 30 days goes by, no payment. I send another reminder letter. You're late. This is the past due, right? Past due, first reminder. Another 30 days goes by. Now the total time lapsed is 60 days. Another reminder goes out. Past due, second notice. Another 30 days goes by, no payment. Now we're talking 90 days. Now it's very likely that the customer's never going to pay us, right? So we look at it from that time frame. And so there's a couple of steps that we want to apply to analyzing the customer's ability to pay us back. The first step is to take the due date of each account receivable that is to be determined. We look at the number of days each account is past due. Then we look at that number, and we look at where it is in our aging. So on our aging report, we have 1 through 30, that's current, or, well, in most cases it's current, or it could be past due if it was like due immediately, right? So 31 through 60 past due, 31 through, 31 through 60 past due, 61 to 90 past due, so forth and so on. 120 plus, 180 plus, right? We see where it falls, and then based off of the aging report, we look at the total amounts, and then we factor a percentage of what's going to be uncollectible. Usually, if it's like 120 days past due, the whole thing's not going to be collectible. It's very rare. I mean, you basically need to go to the customer's door, punch them in the face, and take the money in order to get paid at that point, right? You know, it becomes very difficult for you to get paid back the older the receivable is. So what we have to do is estimate based off of the total amount of where it falls in that on the aging report. That's how we analyze how much we're not going to be paid back. We call that aging the receivables. It's a process by scheduling how long the receivable is past due. Here's a nice example of what it looks like. So your balance not past due, that means it's current, right? 1 through 30 past due. This means they're late. Okay, 64,000. 31 through 60. This customer is past due 31 through 60. Past due 1,500. Okay. That means I probably won't be able to collect 10% of my total receivables. 20%, 61 to 90. Won't be able to collect 20%. Total receivables 61 to 90. 91 to 180. You see the point, right? The older the receivables get, the less likely it is that you're going to be able to collect them. And so you can estimate based off of your total receivables how much you're probably not going to be able to collect. So if my total receivables balance is 240,000, and out of that 240,000, I'm not going to be able to collect 14,000 of that percentage. I'm not going to be able to collect 80% of that 14,000. That means I'm going to estimate that I will not be able to collect 11,200 in that over 365-day column. So essentially what this aging receivable schedule tells me is that I can estimate over the life of the receivables how much I'm probably not going to be able to collect. So this is just kind of the steps of what we took to get there. And of course, as you're writing this off, you debit bad debt expense and you credit the allowance for doubtful accounts as you're writing off your uncollectible accounts estimate. Notes receivable. Notes receivable, as we mentioned, there's a couple of advantages here. There's a legally binding contract agreement between you and your customer. That your customer will pay you a certain percentage plus the percentage interest plus the principal balance. It's usually through a promissory note. Both parties agree to certain terms, and it's a strong legal claim, right? It's like if that customer doesn't pay you based off of that promissory note, you can sue them, right? So again, promissory note, characteristics of notes receivable. There's a promissory note. There are, with face value, there's usually interest, and there's usually due dates. Every 30 days on the first of the month, you will pay me this amount of money total. Within that total, there's a percentage interest and the principal payment. And all of this should be paid off within, 90 days, 120 days, whatever it is, right? So what's in a promissory note? The names of the parties, The maker, that's the person issuing the note. The payee, that's who's going to pay you the note, who's paying the note. The face amount, that's the total balance of the note. Think of a note as a loan. A note is a loan. Same word, right? A note is a loan. Issuance date, when the note was issued, a due date, how long the note is for, and the interest rate. All these things are usually explicitly mentioned within a promissory note. Here's an example of a promissory note. Again, first step, who made the loan? Okay, who's the treasurer? 2, who's paying it, or who's it being paid to? 3, how much is it for? 4, what day was it issued? 5, the date of maturity, or the due date, rather. 6, how long is this note for? 90 days. 7, what's the interest rate? 10%. And we could always figure out how to compute these things, right? How do we compute the due date? In other words, how long should this note be for? Well, how many days are there in the month? 31 days minus the issuance date of the note. We issued it on the 16th. There are 15 days remaining in that month of March. There are 30 days in April. There are 31 days in May. There are 14 days in June that, if it's due on June 14th. So this example, if the loan is due on June 14th, how many days do I have to pay? There are 31 days in March. The loan was issued on the 16th of March. That means there are 15 days left in March. There are 30 days total in April. There are 31 days total in May. It's due on the 14th of June, so that's 14 days in June. That means the life of the loan is 90 days.
Professor,
Fritz,
where do you get I guess a layout of a promissory note? Like, is it a specific one you have to go somewhere to get them in bulk, or is it something you create yourself?
it's something you create yourself usually. I'm sure there's templates online. You could always find a template. You could even ask a bank. You could even ask your bank for a promissory template. You can find them online. You can find it through. You could ask your bank for a template, but it's typically one that you create yourself. But again, you do, like you said before, you want to have it notarized. You want to have both parties sign it. All that stuff. It should be a legally binding contract, right? Yeah, good question. And this is just a visual representation of the life of that loan. It was issued on March 16th. There's 15 days left in March. There's 30 days in April, 31 days in May. It's due on June 14th, 14 days in June, 90 days. So how do we compute the interest on that 90-day loan? So let's take a look. Interest on a loan is computed by taking the face amount times the interest rate times how long the loan is for, divided by 360 to tell you how much the total interest will be for the loan, right? So face amount times the interest rate times the term divided by 360. Now remember, for this formula, every time that you see these little brackets, the open and closed brackets, you need to do that first. Do that first. Figure out that first. Remember, order of operations, yeah? So the total amount that'll be paid to for this loan is $2,050. Why $2,050? It's the total face amount, also known as the principal balance, plus the interest. Interest in this case is $50. Okay, so how do we account for a notes receivable? We debit the notes receivable account for the face face value amount, and we debit the notes receivable account for the face value, also known as the principal amount, and we credit the accounts receivable for that same amount. Now you're asking, what about the interest, right? So when you get paid back the amount, you debit your cash for the amount plus the interest amount. For a $6,000 loan, interest rate 12%, 30 days, we're going to get $60. So how do we know that? How do you know it's $60? Your face value, 6,000 times 12% times the length of time, which is 30 days, divided by 360 in order to get $60. The cash you'll receive at the end of the loan is the face value of 6,000 plus the $60 interest. And of course, that you debit that to increase your cash, and the credit your notes receivable, the face value 6,000, and interest revenue of $60. You always have to break out that interest revenue. You can never lump it together because interest, when you're receiving interest, it's interest revenue. Yeah, separate account. If the person making the loan fails to pay the money, we call that a dishonored notes receivable. Let's see, what else can I tell you? Just another example. It's pretty good. Okay. Let's talk about accounts receivable turnover. This measures how frequently during the year your accounts receivable are being paid, right? Are being paid to you by converting it to cash. To figure this out, you take your total sales and you divide that by your average accounts receivable. How do you get your average accounts receivable? You take your beginning of year and your end of year, and you divide that by 2. Beginning of the year plus your end of the year divided by 2. So it's your sales divided by beginning year plus end of year divided by 2. This tells you the average amount of days that you're turning over your receivables. Another formula that's good to know is called the average days in receivables. It's computed by taking your average accounts receivable divided by your average days in sales. Again, your average accounts receivable is your beginning of year plus your end of year divided by 2. I'm sorry. You take your average accounts receivable, in this case 416. How we get 416? You took your sales divided by 365, 416, divided by divided by your total sales divided by 365, 416 divided by $11.09 to get 35 days. Okay, we made it to the end. Yay! Are there any questions that I can help to answer on Chapter 8, Receivables? We're good? Yay, wonderful. Are there any other
question, Professor? I'm sorry.
Yeah, that's fine, Fritz. What's up?
For the accounts receivable, the part where you have to give out a loan or set up a payment plan for a customer. That is only for if your business allows you or has that option to give out as a service, right? It's not something that every business. Okay, because I'm just trying to apply this to the one I'm doing in the works with my partner, and I don't think I want to have my business structured where the receivables will have that option to give out loans or payment plans.
Yeah, and that's something you don't have to necessarily offer to every customer. Like, so for example, let's say you have a customer that falls behind in paying you on time, right? In that case, you might actually want to talk to that customer about establishing a notes receivable just with that customer. It's not something that you should have widely available to all customers. It should only be used in specific issues, right? So, like, if you have a customer that's falling behind in paying you, you might be like, "Hey, listen, I know that you've been falling behind. In order to get you caught up to speed, let's put your receivable into a notes receivable, attach an interest rate, and say, instead of the 30 days, we'll give you 90 days to pay, right?" So in that case, there'll be a reason for you to do it. But it's not something you would want to offer to all customers, right? It's only to ones that you think we're going to have a problem paying you on time. Does that help to answer your question?
Yes, I'm gonna ask you one more question in regards to what you said. So let's just say my business with my partner does really well, and we go on a larger scale where we offer services. Let's just say to a school district.
Sure.
Is this would be a good setup to have in our back pocket just in case
Yeah.
we're not receiving the payments from the school district?
Yeah, absolutely. Yep. And you do the same thing. So let's say you have a school within DCPS that you are selling lunch trays to, for example. Okay, and let's say all the other schools have been paying you on time except for this one. This one seems to be falling behind or for whatever reason. You would then reach out to that school and say, "Hey, listen, based off of the history of your payments, we realize you're falling behind. Instead of, in order to help you to get up to speed, you would approach that customer and say, "Hey, listen, to help you to get up to speed and to prevent this from going into collections, we'll transfer your receivable to a note receivable, and we'll set up terms, and then of course then you go through the process of setting up a promissory note, things like that." But yeah, absolutely. So good question.
Thank you, Professor.
My pleasure. Are there any other comments, questions, or concerns I can help you with at this time? Are we good? Okay. Now, as a reminder, the midterm is due by the end of this week, as in addition, of course, to the quiz and the discussion board. The exam, it's not timed. It's 20 questions. It's worth 10 total points. You'd only take it once. You can save your answers, come back to it, all that good stuff. There's no rush, but just be aware that it is due this Sunday. And if you need help for whatever reason, or if you have a technical issue and you accidentally submitted it, you didn't mean to, email me right away. I'll get it fixed. Okay, so if there's nothing else, I'd love to call it a day. Thank you for your attention. I appreciate all of the hard work all of you are putting into this class. Please do your best to make sure that you're on top of it. If you ever feel like you're going to fall behind, let me know. I'm here to help you. Thank you so much, and I hope you enjoy the rest of your day.